They intersect because banks are financing stock purchases. But the banking system is a separate, complex system. And it's one that actually the regulators care the most about. If stock markets crash, it's not good, but regulators kind of shrug and go, well, it'll come back, or, too bad. I mean, the NASDAQ fell 80% during the dot-com crash. It came back. It took 14 years, but eventually did come back. But regulators really worry more about the banking system because that's where money is created. You have so much talk about, the Fed's printing too much money. The Fed, they do print money, but it doesn't go anywhere. They print the money by buying bonds, and then the banks that are selling the bonds take the Fed's money and give it back to the Fed. That money doesn't go anywhere. It just inflates the balance sheet. The money that does go somewhere, the money that does drive the economy is actually created by the banks themselves, by commercial banks. When they make a loan, they put the money in your bank account. That money came out of nowhere. The commercial bank created it, in other words. And when banks get into sequential failures, it's the savings are lost, the panic is far worse. So there are a number of ways that AI could accelerate. Again, this is about accelerating, making worse a banking panic. And I use Silicon Valley Bank as an example. That happened in March 2023. It wasn't that long ago. The first warning there is that, we have in the U.S., but also Canada and Europe, bank deposit insurance. We have the FDIC insures bank accounts up to $250,000 each. In Europe, it's 100,000 euros, et cetera. But there's some amount. But in Silicon Valley Bank, they had deposits in the billions. Cisco had billions of dollars on deposit with Silicon Valley Bank. There were crypto exchanges. When they sell crypto, you give them dollars. Well, they take the dollars and put it in the banking system. And one crypto exchange had, again, $3 billion in Silicon Valley Bank. It turns out Silicon Valley Bank, 97% of the deposits were not FDIC insured. That's an accident waiting to happen. And when you look at what did happen on the Friday night when the FDIC closed the bank, they initially said, okay, we're closing the bank. Deposits up to $250,000 are insured. No worries, your money will be available Monday morning. But for any deposits in excess of that, we're giving you like a due bill. It was like a chip. They called it a receivership certificate. And they said, we'll get back to you on what it's worth. We don't know when. Is it 10 cents on the dollar, 90 cents on the dollar? We don't know. We have to figure out the size of the hole on the balance sheet, et cetera. Well, first of all, that can take 6 months to a year. Then you have to sell assets to pay people back. There was enormous uncertainty. So then we had what I call the crybaby billionaire weekend, where everyone was, calling the White House saying, you don't understand. I mean, all these Silicon Valley startups, they've all got their working capital in Silicon Valley Bank, whether it's 5 million or 10 million. You shut it down. They can't make payroll. They can't pay the rent. They can't continue the development. Never mind the fact that 95% of those companies fail anyway. But they were so finally on Sunday night at 6 p.m., the FDIC came out with another statement. They said, oh, just kidding. All deposits are insured. And the next day at a press conference, Janet Yellen basically extended that to the entire banking system. And the Fed, the Federal Reserve, on top of that said, if you're a bank, a member bank, and you have Treasury securities, send them to us. We'll give you 100 cents on the dollar as a 1-year low interest rate loan, even if they're only worth 70 or 80 cents on the dollar, which most of them weren't because they had been bought when rates were 2%. At the time of Silicon Valley, rates were up to 5%. Most of those bonds were underwater. So, okay, we had some more bank failures with Credit Suisse and First Republic, and there were two others, 5 banks altogether. But the point is we got through it. But then when it was over, I thought to myself, well, what did you, the government, what did you just do? You guaranteed every deposit in the system. You tore up your FDIC ceilings. You said no limit. You guaranteed every bond in the system. You said, who cares if it's 70 cents on the dollar? I'll give you 100 cents on the dollar. What have you got left? You've just guaranteed all the bonds and all the deposits. When you have your next banking failure, what's your next move? Well, there is only one move beyond that, which is to nationalize the banks. So that's how delicate this whole thing is. Now, what does AI do to that, what I just described? Well, first of all, we all remember grainy black and white photos from the 1930s of men. It was mostly men, lined up around, with overcoats and fedoras in the rain, trying to get their money out of a failing bank where the doors were closed. It was too late. The insiders had already taken the money. Well, today it's no different. It's just called a run on the bank, except we take our iPhone, we tap a few things, we can send $1 billion just like that. and then we text our friend, hey, get your money out before it's too late. It happens almost instantaneously, number one. And number two, these AI algorithms tend to exacerbate the situation. They can be used to identify where the next banking run is going to be. So the main impact of AI in a situation like this, it takes all the danger I've described, which has been around for the history of the banking system, going back to the 16th century, if you will, but it accelerates it, it amplifies it, it happens much more quickly than people realize, and the results next time will be catastrophic. So we're building AI into all these systems. It does have efficiencies. It does, make things easier. They always sell it on the basis of convenience. But once it gets embedded in the decision-making process, which it is, there's no human element. There's no empathy. There's no sympathy. There's no common sense. There's no something intangible, gut instinct, call it what you want, that would cause people to maybe behave somewhat rationally or understand the problem. AI just goes for the throat, basically shuts down the banking system. So these are some of the dangers that regulators have not considered. I've spoken to a lot of technical experts and people in Silicon Valley and elsewhere, and a lot of them just kind of say, yeah, Jim, new systems are always buggy. They always have things that go wrong. You pointed them out, but we'll fix it. We'll make it better. Just give it time. It'll get better. I don't think that's the case. I would say a couple of things. Number one, with regard to Porter's comment, AI can do art. It can do paintings. It can do music. You may not like it. It may not be your taste, but it can do that. But what it can't do is a form of logic that very few people are aware of. We all know inductive logic. So inductive logic is you see a whole bunch of examples of something. It's everywhere, and you make an inference. You say, well, that must be the way things are. That must be the norm because I see it everywhere. That's sort of David Hume. Deductive logic goes back to Aristotle, where you have his syllogisms. You have a major premise, a minor premise, and a conclusion, and it all flows very logically, and you can demonstrate that. Inductive logic and deductive logic are both easy to code. You can put them into computers. They have flaws. They have limitations, which is why we never got to artificial intelligence earlier. I had my first, conversations about artificial intelligence in 1979 with a consultant from A.D. Little. So it's been around since the 1950s. Why has it never quite got to the level that we see today? And the answer is it's using the inductive and deductive logic with a lot of flaws, including missed examples and false premises. But there's a third branch of logic. It's called abductive logic. It was articulated by Charles Sanders Peirce, who was perhaps the greatest American philosopher. William James credits him with being the founder of pragmatism, even though most people credit James. James said no, it was Peirce who actually did it. He's the father of semiotics. The problem with Peirce, he was 100 years ahead of his time, so we're just now kind of catching up to what he was talking about in the 1890s. But he talked about abductive logic, and there's a lot to it, but the simplest way to describe it is it's all the things that we can't code, we can't program. It's gut instinct, it's emotion, it's empathy, it's sympathy, it's common sense. It's ways that we interact as humans, and it's not programmable. It's never been programmed. And I think the better view is that it's non-programmable. What that means is that the good news is that AI is not going to take over the world because there's an important part of human behavior that cannot be computerized, it cannot be programmed. The danger is that we, first of all, don't realize what I just said. And number two, we let the computers take over the world, even though they couldn't do it on their own because we're not really sensitive to those kinds of human traits that are actually how we prevent nuclear war, among other things. Well, I just pointed out how AI can cause a complete meltdown and closure of the stock markets and how it can cause a complete collapse of the banking system. So one of the solutions is to have assets that are not digital, that are not in the stock market or in the banking system per se. I mean, I have bank accounts. I invest in stocks. I mean, I'm not saying I'm immune from any of this. I'm not. But there are categories of assets that are not digital, that are not in the markets, that are not prone to AI meltdowns. Gold, silver, fine art, land, natural resources, and also things where you don't depend on liquidity. So private equity, venture capital, it's not that they're, immune from loss. Of course they're not. But when you go into a private equity fund, you don't expect to see your money for 5 or 6 or maybe 7 years. So if there's a stock market meltdown, you're like, okay, too bad. Maybe you lost some money in the stock market, but it's not really going to affect those investments, which are much more long-term. So I'm talking about diversification, but when you say that, people yawn. They go, oh, of course, Jim, we need to be diversified. But most people don't understand diversification. They think it's having 50 stocks in 10 different sectors. And I say, no, that's not diversified. You may have 50 stocks, but you have one asset class, which are stocks. And when you don't care, they're loosely correlated. When you do care, they're completely correlated. They'll all go down together. But if you have these other assets, and even cash, to the extent it's FDIC insured, or you spread it among other banks, gold, silver, fine art, land, or things where you don't depend on liquidity,